The million-dollar question? Where should Americans actually invest their money? Becoming a millionaire in today's market sounds easy, right? But here's the real question that keeps every American up at night. Where should your hard-earned money actually go? Gold? The S&P 500? Bitcoin? Real estate? Treasury bonds? Or maybe just a simple index fund? Turn on CNBC, scroll through Twitter, open your Robinhood app. Everyone's got an opinion. This is mooning. Buy the dip. This is financial advice. But when the market crashes, suddenly everyone goes quiet, and who's left holding the bag? You are. Here's the truth. Anyone can talk. But data never lies. So today, we're cutting through the noise with Money Timeline, where we let the numbers do the talking. 2016 to 2026, the $1,000 challenge. Imagine it's January 2016. You've got $1,000 burning a hole in your pocket. Maybe you just got your tax refund. Maybe it's a bonus check. Whatever it is, you're ready to invest. Let's see what happens to that $1,000 across different assets over 5 years, and then 10 years. Buckle up because some of these numbers might shock you. GOLD, the safe haven. Your grandparents loved it. Central banks hoard it. But does it actually make you money? $1,000 in 2016, worth about $1,438 in 2021, worth about $2,375 in 2026. Not bad. Solid, steady growth. It's like the Toyota Camry of investments. Reliable, boring, but it gets you there. Silver. Gold's volatile cousin. Silver is cheaper to buy, but way more unpredictable. $1,000 in 2016. Worth about $1,548 in 2021. Worth about $1,486 in 2026. See that? 5 years of gains almost wiped out. Silver's like that friend who's super fun 1 minute, then ghosting you the next. Bitcoin, the roller coaster. Oh boy, here we go. If you put $1,000 into Bitcoin back in 2016 when it was around $430, by 2021, you're sitting on approximately $101,728. By 2026, about $162,518 based on average price, not peak. Let me repeat that. $162,000. From a single $1,000 investment, but, and this is a massive but, your heart would have stopped about 47 times along the way. Bitcoin crashed 80% multiple times. Most people, they sold at the bottom in panic. Real estate, the American dream. Let's talk property, but not just any property. Let's look at the median home price in America. If you somehow invested $1,000 proportionally into U.S. residential real estate in 2016, by 2021, worth about $1,312. By 2026, worth about $1,445. Real estate grows, but slowly. Plus, you've got property taxes, maintenance, and you can't exactly sell half a bathroom when you need cash. The advantage, it's tangible. You can live in it. But the disadvantage? It's illiquid. Try selling a house in 24 hours. S&P 500 VU SPY, the index fund classic. This is what Warren Buffett tells everyone to buy. $1,000 in 2016, worth about $2,073 in 2021, worth about $3,347 in 2026. More than tripled your money in 10 years. No stock picking, no stress, just boring, beautiful compounding. NVIDIA Stock, the AI dream. What if you got lucky and picked the winning stock of the decade? If you invested $1,000 in NVIDIA back in 2016, by 2021, it was worth $14,831. By 2026, approximately $31,446. Absolutely insane. But here's the catch. You had to know AI was coming. You had to hold through every dip. Most people didn't. Treasury bonds, the government guarantee, the safest investment in America. Backed by the full faith of the U.S. government, $1,000 in 2016, worth about $1,124 in 2021, and $1,411 in 2026, barely beats inflation, but you sleep like a baby at night. Let's rank these from safest to riskiest. Low risk, U.S. Treasury bonds, high-yield savings accounts, CDs, index funds, blue-chip dividend stocks, medium risk, real estate, gold, individual growth stocks, high risk, silver, small cap stocks, cryptocurrency. Here's the rule: higher potential returns equals higher potential losses. Bitcoin made some people millionaires. It also made some people broke. The S&P 500 won't make you a millionaire overnight, but it also won't wipe you out. Why do we even invest? Let me ask you something. Do you invest to see a bigger number? Or do you invest because you want to maintain your purchasing power?
Think about it.
In 2016, the median home price in the US was around $295,300. By 2026, it's closer to $420,000. If you just kept your $1,000 in cash under your mattress for 10 years, guess what? You still have $1,000. But what you can buy with that $1,000 has shrunk. A lot? Gas? It's more expensive. Groceries? Way more expensive. College tuition? Don't even get me started. That's inflation. Inflation is why cash is not king. Invested cash is king. Long-term thinking wins. If you're checking your portfolio every single day, if you're panicking when it drops 5%, if you're celebrating when it goes up 3%, you're not an investor, you're a trader. And statistically, traders lose money. Why? Because they buy high when everyone's excited and sell low when everyone's panicking. Real investors, they think in decades, not days. Warren Buffett didn't get rich by checking his stocks every hour. He bought great companies and held them. Money Timeline's 5 golden rules for American investors. Rule 1. Fear and greed. When the market's hitting all-time highs, everyone's a genius. Or Uber drivers giving stock tips, that's greed. When the market crashes and everyone's screaming sell everything, that's fear. The winning move. Buy when there's blood in the streets. Sell when everyone's dancing. Remember, March 2020. The world was ending. The S&P dropped 34% in weeks. People who bought then, they doubled their money by 2021. Dude, Dogecoin is up 400%. I gotta get in. This is how people lose money. They chase what's already hot. They buy at the peak. Then they panic sell at the bottom. Don't invest because everyone else is. Invest because you did your homework. Timing isn't everything. People waste years trying to time the market. Should I wait for a crash? Is now a good time to buy? Here's the truth. Time in the market beats timing the market. The best time to invest was 10 years ago. The second best time. Today, start small. Stay consistent. The compound interest do its thing. Never put all your eggs in one basket. Diversification isn't just a fancy word, it's survival. Your portfolio should look something like this. 60 to 70% in index funds. S&P 500 total market, 10 to 15% in bonds, especially as you get older. 10 to 15% in real estate REITs if you don't own property. 5 to 10% in gold or other hedges. It's 5% in high risk, higher word crypto, individual stocks. Where the risk is higher, invest less. Where the risk is lower, invest more. Do your own research. DYOR. Research doesn't mean watching one TikTok video and calling it a day. It means reading financial statements. Following trusted sources, Bloomberg, WSJ, Forbes, The Motley Fool. Understanding what you're investing in, knowing the risks. If you're buying a stock, do you know what the company actually does? Do you know its PE ratio? Its debt levels? If you're buying crypto, do you understand the technology? The use case? This is your money. You worked for it. Respect it. The bottom line. Here's what we learned today. Higher returns don't automatically mean better investments. Diversification protects you from disaster. Long-term thinking beats short-term panic. Data beats hype every single time. Your $1,000 in 2016 could be worth anywhere from $1,400 to $162,000 in 2026, depending on where you put it. But the real winners? They're the ones who stayed invested, stayed diversified, and didn't let emotions drive their decisions. This is Money Timeline, where we base decisions on data, not emotions. In the next video, we'll break down another asset class using pure, unfiltered data. Until then, invest smart, stay curious, and take care of yourself and your family.